Just a quick overview of the program for today. So the first hour, Matt's going to present to us on leasing and the economics of the deal. After that, we'll have two sessions run back to back. Dave Rigg will do a half hour on tax planning methods relative to the industry. And that'll be followed by Brent Impekoven giving us some tips and pointers on just efficient ways to do our work when it comes to documenting and performing reviews of contractors. After that, we'll do a roughly 1 hour break, and that'll be followed by the last hour. Jason our business development director will lead a 1 hour session on business development. So really looking forward to today. And with that, Will, I'm going to turn it over to you to introduce Matt, please. Okay.
Awesome. Thanks, Wade. And Matt, thanks for being with us today. It's my pleasure to introduce Matt Weist to us. Matt's a good friend of mine, and he's with Column Commercial Partners. He's a commercial broker there. And we asked him to give us an update in terms of the leasing market out there. And one thing that Wade talked to us about yesterday was really the overlap between the construction and the real estate arms that we have, and meeting in the middle of that Venn diagram. And so much of the leasing market impacts us in many different ways. Obviously, on the real estate side with our owner operators, the leasing market is huge to our clients. And from an accounting perspective, we might have a lot of lease modifications this year with COVID and everything going on. There are accounting implications to that. There are valuation impacts to that they could have on buildings and commercial property and potential impairment that we might be seeing. And then from a development standpoint and the construction side of things, how does the leasing market impact overall developments and the backlog that they had versus the backlog they have now and moving forward? So with that, Matt, thank you for being here. I'll let you tell us a little bit about yourself and your company and take it from there, but thank you.
Awesome. Thank you, Will. And thank you for having me on. I'm going to share my screen. I saw somebody asked if you guys had access to the slides. I'm not sure if you do, but I'll just share my screen anyways so that we can utilize that. Good morning to all of you guys. Welcome to today's webinar. We're going to be talking about the state of the Denver commercial real estate market, and I'll touch on how that affects nationally, but strong focus here in Denver. As Will noted, again, my name is Matt Weist. I'm with Column Commercial Partners. So Column is a Denver-based commercial real estate brokerage, and I personally focus on tenant and buyer representation, with my lane being in office and industrial flex clients, which we'll touch on what that looks like. But today we're going to go over quickly the Denver job market, and then we'll go over the office leasing and sales market. Then we'll touch on the industrial leasing and sales market, and then give you a little bit of a snapshot of the future of office leasing as we see it. And I'll touch on some of the things that Will brought up early on here and how leasing will impact certain aspects of the commercial real estate space. So let's jump in. This first report here and chart is the job growth since 2010, and it's comparing Denver and the US. So the previous 10 years, Denver's been tracking slightly above the US in terms of growth in the job market. Much of that, we believe, is partly because of diversification in industries for Denver, as well as becoming a secondary tech hub. And what I mean by diversification, and I'll touch on this a little bit later, but Denver for a while was very focused in oil and gas. And with an excellent job, in my opinion, of diversification there, we've kind of luckily gotten away from a lot of that. And again, I'll touch on why that matters in a bit here. But it's also an area where a lot of companies are setting up sites for second headquarters. We've become a major hotspot for startups and startups that have made it. I mean, if you look at SendGrid, which was recently acquired by Twilio, Go Spot Check, Ibotta, the list goes on, but there's a lot of industries here in tech industry that are doing quite well. Looking back to the chart here, obviously we see the dip in Q2. I don't think there's a shock here for anybody. The drops really mirrored the pandemic, but also there was oil and gas market plunge earlier this year that had an effect locally here in Denver, and we'll talk about that a little bit more later, but it definitely had an effect early on. Denver, as was the case in the Great Recession, really not hit as hard as the rest of the US. As we look kind of at these lines here, the dip for Denver was less than 9% compared to almost 14% nationally. And I think this has been aided by a number of things. I already pointed out diversification. The other thing The number of jobs in retail and hospitality in Denver are near or below the national average, and therefore Denver's not overly exposed to some of those hardest hit sectors. Another factor aiding in this, and this is at least according to CoStar. So quickly, CoStar is the national commercial MLS, as you will have it, where we search for commercial properties, commercial data, et cetera, et cetera. They say that office using jobs in Denver have grown above the national average for the past 5 years at about 3% annually. So that means that the industry diversification in Denver, and there are a number of jobs that were less affected during the pandemic once companies really implemented a work remote option. And then as we can see, Denver and the US nationally here are both ticking up. I believe last week the number of jobs regained was somewhere around 11.4 million across the country. Moving into net employment changes locally here in Denver. Real quick, as we look at this bar here, Denver lost 136,000 jobs in April right after the pandemic. And just to put that into context, during the Great Recession of 2008 and 2009, Denver lost about 67,000 jobs. So almost double that in 1 month. Good thing is, as of last week, according to the Downtown Denver Partnership, which is a collaboration of board of directors, civic leaders, and others working on economic sustainability for Denver, the number of workers filing new claims dropped by about 75,000. And we expect to continue seeing that unemployment ticking down at a slower rate. But as we can see on this chart, expectations are by Q2, Q3 21, we'll be in a position where Denver's adding jobs back in. Again, I kind of mentioned this already, but things that have really helped Denver from a job perspective, the retail and hospitality sectors, and then the job of diversification of sectors and industries in Denver. So Denver and state leadership have really incentivized companies to choose Denver to help move away from a heavy reliance on oil and gas that the city and state really once had a focus on. And I don't want to say that that's completely moved away. Denver still has a strong focus in oil and gas, but the diversification has helped. So again, this is, the fact that Denver is as diversified, it really helped with what happened in the first quarter of oil and gas market plunge. And an example of that is Extraction Oil and Gas, which is a huge company in downtown Denver, laid off 20% of its Colorado workforce. Whiting Petroleum, another one, had massive layoffs in the second quarter, which all affected what happened in the office market, of which I will chat about here in a second. And then tech and professional services, and I'm sure a lot of you guys can attest to this, have really maintained employee counts pretty well with remote work options, aiding in both retention and addition of staff in certain companies. So if you have an opportunity to work remotely, the office effect might change, but it's not affecting a lot of companies that have those options from a job employment perspective. So let me pause real quick before we jump into the office details and see if anybody has a question that they want to ask. So jumping into the office market and what that looks like in Denver, and then as well as nationally, we'll go through this first slide, and this is a very busy slide, but at a high level, it's talking about absorption, deliveries, and then vacancy rates charted both in Denver and nationally. Absorption is the space being leased or taken. Deliveries are new construction delivered and ready for lease. And then obviously vacancy rates are space that is not leased up. So looking at vacancy first, Denver vacancy rates dropped to nearly their second lowest rate in the last 10 years in the fourth quarter of last year, but obviously have ticked back up as we can see here. And that's all in relation to oil and gas market plunge and then the pandemic. Denver had tracked to the national levels of leasing and was actually higher from about 16 all the way through to the pandemic, and has kind of stayed above the national average despite really strong fundamentals for the last cycle. So part of this is because as we look at the number of deliveries that have come on market, so construction being released for leasing, that's helped, it actually pushed up vacancy rates. But it also shows you how well the national real estate market has done on a whole during this last cycle. So that's keeping a lot of landlords very pleased. As I mentioned, Denver's office market entered 2020 on a high note, even with spec construction, which I'll talk about in a little bit, continuing to put that upward pressure on vacancies. Demand has been strong enough to compress that to what was actually cyclical lows in 2019. And just for a little bit of context, as we're looking at all these charts and bars, and there's a lot over here. Again, it's a busy graph. About 1.2 million square feet was delivered in 2019, and 1.8 million square feet of office space was absorbed. So we had 1.2 million square feet of new and about 600,000 square feet of current space that was taken last year in terms of lease ups. Since the pandemic started, absorption is really taking a hit. And a lot of that has to do with the oil and gas market that I touched on, but also folks realizing we want to put our space up for sublease and get out of these financial obligations. The energy sector is a huge contributor to this, with roughly 900,000 square feet of space going on the sublease market early this year. I touched on extraction and whiting. Those are two of the larger ones, equating for about a third of the total space that hit the sublease market for energy alone. So of that 900,000. Another thing to note is it's on a smaller scale, but WeWork has started canceling leases in Denver, and this is going to be a nationwide scenario most likely, and we've seen that they've started doing it in New York, Chicago, and larger markets, but they have canceled 140,000 square feet, and there's rumblings that they're canceling at least another 65,000 in a Rhino spec building, and Rhino being a trendy Denver neighborhood. I'll talk about that in a little bit, but they're talking about canceling or abandoning another 65,000 square feet. So a total of over 200,000 square feet of leased space in Denver that they're talking about walking away. And there's still questions around, are they going to honor these leases after the failed IPO, after the CEO being let go? And there's a lot of shuffling with SoftBank. So I bring that up for two reasons, but I do also want to note that they only account for 0.5% of the office square footage locally. WeWork does. Co-working in general is a little bit larger than that, but it's going to raise a lot of questions for landlords moving forward. But co-working in WeWork was also a huge driver in a lot of the deliveries and Class A buildings that started getting built here in Denver. And I'll touch on that in a little bit here. Going back to the chart, just really finishing up here, deliveries on the upward trend, but really what is that going to look like for future absorption? So next year, we're looking at nearly 2.5 million square feet that's going to be delivered in Q1 and Q2. But we have a lot of space that's hopping onto the market, both from sublease and folks that have their leases coming to the end of the term and deciding what looks like next. And I have to caveat this, there's so many directions this market can go, but Denver will continue being a very strong market for tech and startups, specifically as they look to relocate from either larger or the more expensive markets like San Francisco and New York. And I have more detail on that in a couple slides here. So just going into talking about the deliveries a little bit more, this is a slide that shows buildings that are under construction. Due to the massive run up and the fantastic market that we had in the US as well as locally, many developers began building spec construction. And just again, I keep saying spec construction, that's speculative construction. And for context, it's purely built on the expectation that demand is so high that there won't be issues leasing up that building once it's completed. In fact, the percentage of spec development was at 10-year highs right before the pandemic hit. So people really wanted to get in on that to get a piece of that pie. So this chart is showing buildings that are currently under construction. So they've already begun. It's worth noting that new starts of construction are just over 100,000 square feet in this last quarter. So we have over here looking at just shy of 3 million square feet under construction and only 100,000 started in Q3, 100,000 square feet compared to 3 million. And a lot of that is, and speaking with developers locally and listening in on a few other webinars, developers are really saying that if they don't have shovels in the ground, if the project hasn't been started, they're going to wait and see what happens because there's a lot of questions to the market coming. I touched on this earlier, but an example of a speculative play locally in Rhino, which is, I don't know if I have any South Park fans on the line here, but it's a trendy up and coming neighborhood in downtown. And for those South Park fans, I like to reference Soto Sopo, kind of just a funny little note there. But this Rev 360 building out in Rhino, we were committed to 65,000 square feet, which is roughly 2/5, 40% of the building. And with them indicating they're backing out of that lease, that building is now going to be sitting at 100% vacant upon delivery at the end of this quarter or the beginning of next quarter. So there's a lot of questions as to how that's going to be affected moving forward. Another spec development in Denver that's expected later this year, early in 2021, is a building called Block 162. It's at the corner of 15th and California. It's a Petrinelli Group and USAA real estate company joint venture. 608,000 square foot project, and to date they don't have any pre-leased commitments. So there's a lot of square footage. Again, I said 2.5 million coming to the market, getting ready to be delivered, and it's tough to get those leased up. And I bring this up for multiple reasons, but number one, like during the run up and during this last cycle, this wasn't the case. The Heinz building 1144 15th, so just down the street from Block 162. That was a 672,000 square foot project, and it was pre-leased before, 75% pre-leased before completion. Some of the space has come back on the market, but some of that space is actually tied to Chipotle. And for those of you that aren't familiar, Chipotle was headquartered in Denver. They have since decided to move out of Denver a couple years back here. They signed a 15-year lease on 125,000 square feet. So that stuff hit the market again. But technically, Chipotle is on the hook for it. So the landlord isn't in a position of needing to worry about what to do until Chipotle can sublease that. And then another good example is for the Denver-eyed folks. Your office space in Denver, Bellevue Station, was developed by Ramrock, which is a group out of Dallas. Western Union agreed to take 80% of that, leaving just a little bit of additional office space, including what I took over. So a lot of buildings that were spec or considered spec, but were pre-leased well before anybody either put a shovel in the ground or completed the project. So again, going back to Block 162, I think that's going to be a great barometer for developers thinking about Denver and nationwide as the market recovers. So, you know, how long does it take for the market to turn around? And then how are landlords and developers going to work around getting their spaces leased up? And I'll touch on this a little bit more, but we're already seeing landlords that I think they get the picture. It's better to have bodies in the building, or at least the space leased up, rather than trying to go after what their current marketed rate is. And I'll touch more on what I mean in a couple slides here. But it really just explains why developers are going to sit and wait and see what happens in the Denver market. But this is happening nationally. This isn't specific to Denver. It's happening all across the US, where developers are playing the wait and see game. Moving forward, this is a little bit more in depth on the absorption, delivery, and vacancy slide. So we've got 3-star, which is kind of Class B type buildings, 4 and 5 stars, more of the Class A buildings. And then green is Denver, yellow is United States. So we kind of already touched on Denver versus the US vacancy rates for the last 10 years. But much of the early development and spec development in the Class A buildings, those 4 and 5 stars here, were due to the excitement around co-working. And then also locally, we've had a lot of success with some of the tech and startups that have really blown up, and companies identifying Denver as a great, less expensive market. For example, Amazon coming here, and I wouldn't call it their second headquarters, because we already know the debacle that happened with Amazon's second headquarters, trying to identify a market that would work for them. They still are taking 100,000 square feet in Lodo, which is nothing to blink at. A couple other companies that are coming out of the Bay Area. So again, moving from something that's quite a bit less expensive. We've got Gusto and we've got Slack. Gusto taking roughly 60,000 square feet. Slack plans to hire over 500 employees, and they have 80,000 square feet down at Union Station. So it's not a surprise that the vacancies went up in Q2. We talked on that. But a part of that is as some of these leases are rolling, so ones that had expirations in 2020, a lot of companies are making the decision that there's too much uncertainty. We have to work remotely anyways. We're not going to engage into a long-term lease obligation. As we look at this chart, the expectation is that things will level off. If we're looking at the forecast over here, things are going to start leveling off around 2022. But what does the market look like when that happens, and how much space are companies taking may look drastically different. So it's going to be interesting to watch as companies change their mindset around what office looks like. I like this slide because it's actually a really good illustration of vacancy rates decreasing and then the market rates increasing over this 10-year period that I keep talking about. Really puts into perspective why folks wanted to get into spec development. There was vacancies dropping, a lot more demand, and the market rates keep going up. Everybody really wanted a piece of that pie. Again, I touched on this a couple times already, but with all the new deliveries, that 2.5 million square feet or so coming in early 2021, there's a lot of uncertainty that exists in the market. Landlords are going to be a lot more willing if they understand what's happening to get deals filled, get deals done, spaces filled. You know, something that's pertinent to you guys, a lot of factors will play here on how this affects the accounting perspective, but things that you're going to want to consider are: when did the landlord purchase the building, what type of financing on the building, and what type of debt exists and remains, and then the expected versus the realized rates. You know, every year landlords go through the expectations and create their own pro formas. So how close are they going to be to those types of expected versus realized rates? And I don't think that this chart here shows what we're personally experiencing. We see a little bit of a dip here in 2021 or 2020 moving into 2021. But anecdotally, I can tell you in the last 3 months, deals that we're signing, and we're up to 4 deals now in just the last 3 months, that we've gotten at least 20% discount from advertised or pre-COVID rates, and sometimes upwards of 30% discounts from those rates. So a lot of deal making, a lot of decrease in the expected market rates moving forward here. On to the next slide, looking at rent growth and what that's looked like in Denver versus the national average. Again, green being Denver, yellow being the national. Denver's tracked pretty similarly to the national average for the last few years, and rent growth is really slowing after reaching those peaks. And at $28 a square foot, which is, if we go back to this previous slide real quick, is about where we're at here at $28 a square foot for the Class A buildings. Denver really comes in at a substantial discount relative to other tech markets. So Bay Area, for instance, is going to be about twice that much. Seattle and Austin are going to be about 35% higher. So this factors into how does the market look moving forward as Denver continues being an attractive place for companies look to either make their permanent homes, set up second headquarters, move some of their staff like Gusto and Slack are doing, and really looking at an up and coming job market as well as a less expensive office market. You know, we still expect to see some decreases in the market rent moving forward. And again, the forecasting from CoStar is indicating that it'll be about 2022, end of 21 before we really start seeing rates increasing again. And I think personally, that may be a little bit of an optimistic view. I think we might have to push into mid to late 2022 before we start seeing how this market is affected, but only time is going to tell. And I just really want to keep pointing out that, as I touched on in the last slide, we're experiencing 20% plus discounts on deals right now. And then with lease rates dropping, valuations and investor expectations really are going to start taking a shift. And how they're valuing the buildings and what that will mean for you guys moving forward. But I'll get into that in a couple slides here. I wanted to show this slide for the purpose of what the sublet market looks like. it's significant to talk about how much has flooded the market, which is another piece of information that landlords have to consider when negotiating deals right now. So through the first 2 quarters of 2020, there was roughly 3.5 million square feet of sublet space. And as of the start of the fourth quarter, we're up to 4.6 million square feet of sublet space, which is up nearly 75% year over year. A lot of this, has to do with oil and gas, but this is the most sublet space available on the market of any time, including the Great Recession, including all of the other oil and gas price fallouts that have affected the Denver Central Business District over the years. So it's really worth noting. And then on a national level, the number of sublease space available is just shy of 150 million square feet. And that's up 45% year over year. So again, Denver's not the only one seeing large swaths of sublease space coming onto the market. And I touched on this earlier. Whiting Petroleum Extraction, they're about a third of that 900,000 square feet of oil and gas sublease space that has come to the market. Another thing worth looking at, because this was actually really talking about the market prices for direct in the orange, sublet for the blue, and it's interesting to note that the key and divergence rate here has to do a lot with, number one, the continued growth rate in the direct leases over the last 4 years. So we've got subleases that are hitting the market that were struck, 3-4 years ago that have 3% annual increases when Denver's been experiencing more than that. So their current rates that they're in at maybe less than what the marketed rates are for direct from the landlord. And just as I said, landlords are going to start looking to get deals done. Sub-landlords trying to get out of their financial lease obligations, they're going to want to try to start getting deals done. And we can already see that by the divergence here as the sublease asking rates are already lowering. And I just expect that to continue as we move into the future. Getting into a little bit of the sales volume, investment activity is really slowed dramatically as the financial impact of the coronavirus is assessed. So people are sitting back and waiting, and what does the future look like, which is a complete shock from the beginning of this quarter. We actually saw one of the largest non-bulk portfolio trades ever recorded in Denver when Brookfield purchased a couple assets in downtown from Shorenstein. That space, nearly 1.3 million square feet, was bought at $400 million, which is $311 a square foot. So I point that out because as we're looking over here on the chart, Denver's price per square foot is the blue, nationally the green. So again, Denver well below the national average. But when we look at Q1, when this deal was completed, national average was above 320 a square foot, and Denver's down here below 250. So people before the pandemic viewed Denver as a great market to purchase into, and were willing to pay a premium to get into the market. And then since the pandemic hit and the fourth quarter appears to be really lackluster, we're going to see, and we already are seeing the drop, but we'll see an even greater drop here in Q4, which has historically been in Denver at least, one of the hotter quarters, and topped out in $1 billion for the last 2 fourth quarters of 17 and 18 before last year. Cap rates, another focus area and something that's going to impact valuations of buildings, expectations from investors. But the cap rates have moved up to 7.2%, which is about 10 basis points year over year. And we kind of expect that to continue trending upward as investors are seeing dropping lease rates and they're seeing vacancies rising. This is a signal to them that they're going to be taking on more risk, and therefore they want a greater return on their money. So this is going to have an overall impact on the values of office assets as the higher cap returns equate to lower price points. And again, we're not seeing this just locally in Denver. This is nationwide at the moment. I don't want to be all gloom and doom because I think we will hit a point where things change, but this is no different across the nation. So I'm going to pause again. That's the end of the office market section. Let anybody put out some questions.
Matt, I have a quick question for you on this, and I know you represent a lot of folks on the tenant side. what are you seeing in terms of, and I don't know what the numbers are, what they were looking for in terms of square footage per employee pre-pandemic versus what they're looking for square footage per employee post-pandemic?
That is a great question. Off the top of my head, I don't, actually, let me rephrase this. So that is a great question. It depends on the office type. So as we've gone through the 2010s, the teens, the style of office has changed. So we've gone from a lot of professional services where it's heavy office centric to more of that open concept. I don't have a what are we looking at now, but leading up to it, if you were in more of that techie, open, creative concept, square footage per employee was roughly 200 to 250 square feet. With the 6-foot requirements and getting back into the office, you could easily see a 50% factor added onto that and possibly more. So I think recognizing how the pandemic is affecting certain office setups, that's another reason that tenants are going to look and say, let's wait until we see what the future looks like, because the pandemic's not going to be with us forever, right? And tenants don't want to sign into 50% extra space long term when the reality is, and I'll touch on this towards the end, maybe we actually want less space and we have folks coming in on different schedules or whatever the case may be moving forward. But
Gotcha.
200
Very
to
good.
250 creative tech open is what architects design to these days.
Thank you.
Yeah. And then was there another question?
Someone didn't know what app you were speaking of.
So CoStar, is
okay.
that what?
I think so. It said,
Okay.
I don't know of this app that you speak of. Are you talking about on a phone? Sorry, old dog, new tricks. So
Yeah. So CoStar, again, CoStar is for the commercial real estate space. You have to have a license to utilize it, but basically it is the tool that we utilize to identify properties, to identify trends and analytics in the commercial real estate in the real estate industry based in Denver as well as nationally. So it's our commercial real estate tool. So let's move on, shift gears into the industrial market a little bit. So you guys have seen this chart before now. We've got the absorption, deliveries, and vacancies. I would say during the pandemic, industrial has actually been one of the more resilient assets. E-commerce and third-party logistics, the 3PLs really particularly, thanks in part to everybody realizing if I'm at home, I need to order stuff. So taking advantage of the Amazons of the world, and then you've got the third-party logistics setting up in terms of how do we deliver that and needing more space. Something that always gets brought up in regards to industrial space in Denver, and I want to touch on this, was actually how did legalization affect the market here? And I point that out because there's a few interesting things within this chart that really talk to how the market has changed here locally. So in 2013, you can see that these net deliveries were actually negative, meaning that, and I'll touch on this on the next slide, but there were demos that happened, demolitions of old product in Denver right before legalization hit in 2014. So we lost product, and all of a sudden we had a need for warehousing space that created a demand shock on the order of about 1.5% to 2%. So it's not a staggering number, but the vast majority of the demand occurred quite quickly in 2014 as all these demos were occurring. So in a market that was already tight and speculative development really hadn't started yet, there was enough to squeeze the market to historically tight conditions. And I think this is worth pointing out because, in my opinion, national legalization of marijuana is probably a matter of when and not if. And that may have a very similar effect on other jurisdictions where at least medical hasn't been legalized yet. And that'll be something worth watching. So it created quite the supply issue and a strong demand issue. As we can see, vacancy rates dipped to 3% by the end of 2015. And developers began to realize that construction and spec construction was going to be very important here in Denver. And so investors, landlords really hopped on board with construction in the Denver market for industrial. And as rates started ticking back up, vacancy rates, we kind of fell in line with national average right around mid 2019, and have since just passed the national average, thanks in part to a lot of spec development. I do want to note there's this larger absorption right here. We view that as a blip, not something that is going to be sustained. And part of that was 240,000 square feet of Toshiba warehousing they vacated in August, which had a decent effect on this absorption number here. So we kind of still view this market as a strong market moving forward. And I'll get into that here on these next slides, but deliveries continue to be strong and demand continues to be strong. Again, I touched on, so here in 2013, right towards the end, nearly 3 million square feet of old warehouse product, industrial product was demolished. So 14 hits, a lot of demand, and this ushered in really new levels of spec development. And those have been on the uptick since, and even finally kind of topping out, it looks like here in right before the pandemic hit. But that's not necessarily relative to the pandemic. It's just a matter of everything that was slated to be delivered. Again, this pandemic has really shown that there's a strong need for warehousing, with the third-party logistics and e-commerce, including that last mile, that have really driven demand in construction and expectations. We really expect this to just continue into 21. Those areas, 3PLs especially, but they're going to help drive the supply chain locally and then nationally. So we see this both in Denver, we see this nationwide, and it's going to be a strong market for investors and owner users and landlords. This is a quick little snapshot of what's existing in the market and then what's under construction. Again, it talks to the realization that third-party logistics, e-commerce are really taking over, and what's under construction are these logistic properties that are over 100,000 square feet. So 81% of what's under construction right now falling into that large scale logistics type property. It's worth noting, I had mentioned that Amazon's taking 100,000 square feet of office space in Denver. They also took 400,000 square feet of warehouse space up north of Denver. And that trend is going to continue for Amazon, for the other third-party logistic providers. And that's why a lot of this under construction is, again, these large-scale logistics properties. And then nationally, something that drives, it will continue driving here and nationally, is manufacturing. Of the total demand on a national level, manufacturing takes up 22%. So we've got the old school. This is what we always have used industrial warehousing for with manufacturing. And we've got I'll call it new school. It's not totally new school as we move into third-party logistics and Amazon world and e-commerce world. So this chart looks like I lost my key, but real quick, specialized type of assets. So that's non-logistics is this orange. Blue, the light blue one up here is the logistics number. Green is what is considered a flex number, and green or flex being a combination of warehouse and office. And then we've got yellow for the Denver market, and we've got this dark blue for the United States market. So, obviously note again that spike in 14 for rent growth. We've already touched on that, but that was predominantly because of legalization of marijuana. Worth noting that industrial rents are more than 60% above the peak of the previous cycle. So Denver has historically performed better, and that actually is one of the best performances in the nation. Finally started moderating towards the end of 2019, but prior to that, we were having annual gains of more than 7%, which is unheard of. Those are some incredible numbers for any type of market rent growth, even during a hot market. The expectation over the next 6 to 9 months, maybe they fall, as this chart shows, a little bit, both locally and nationally in terms of market rent, but we don't expect to see that too much. I mean, it might be brief dip below 0%, but I would actually be surprised if we don't just level out for a little bit and then increase again. A lot of spec development is continued in Denver, and unlike what I talked about in the office market space, I think industrial spec is it's going to continue due to high demand, and I think this market and this asset class is going to continue performing very well, continuing moving forward here. So keep your eye on what happens in industrial, both locally and nationally, but it's a completely different picture than the one I painted for office. And then getting into sales volume, again, it looks like my key is gone here, but orange being the sales volume. And then we've got blue being Denver and green being the US. So unlike office space, Denver has performed at a higher rate than the US nationally here. Investors remain enthusiastic about Denver's industrial fundamentals. And we talked about office setting records. 2019 was a record year for industrial, $1.7 billion worth of assets traded in 2019, which is a staggering number. It's 200 million more than 2018. We will see a slight pause here, I think, because everybody is, again, checking fundamentals of the market. But I do not expect industrial to slow in 2021. I think everybody has adjusted, reevaluated, and said, all right, we still will push forward with what we saw in 2019. May not hit 1.7 billion, but it'll be on the stronger side in my expectation. Again, a part of that is because of a strong demand in logistics. It's a rise in e-commerce. So another thing I actually wanted to point out on this slide, so I got to check my notes here, but in the national numbers, we are expecting and seeing a bit of a larger dip than what we saw in Denver. And I can tell you anecdotally that we've had a couple clients on the purchase side working in the flex and industrial arena where we couldn't get landlords or owners or sellers off of their price. So in office space, it's very easy to go in there and get that 20 to 30% discount I was talking about. We have not seen that in the flex and industrial space. So kind of a different market. Expectations moving forward are strong that this sector will continue on the uprise. I'm going to pause again for questions. See if Will, you have any questions, or anyone in the chat has questions. All right, well, it looks like I have about 10 minutes left, so I will bring this to an end with what we kind of see as the future. I'm going to focus more on office, just finalizing industrial. Again, I think industrial really has a strong foothold and will continue moving forward in the direction it has. Again, there might be a slight pause like we saw in Q2 and Q3 of this year, just based predominantly on what is happening from a financial aspect with the pandemic. But there's a lot of demand, strong desire for those types of products. The future of office. So, as people moved into this remote work scenario, a lot of things changed, but people also were able to identify the fact that it could be just as efficient. I say it could be. Some folks may disagree with that. Working remotely versus being in the office. But a couple surveys that have been performed that I want to touch on, according to Castle Systems, and Castle Systems provides access control technology, or key fobs, for their clients. So this survey came and is based on access card data entry. Denver had about 25% of the office space currently occupied as of the middle of this month. So of the office space that is leased, not on the sublease market, that people still have as their current office, only 25% is currently occupied, meaning 75% are still working remotely. The highest concentration of workers back in the office are in the Miami area and the Dallas and Fort Worth areas. And each of those are at 44.3 and 43.3% respectively. So interesting little tidbit about who's actually back in the office versus who's continuing to work remotely. Another survey came from a company called DealAid, and they surveyed, actually I have two different surveys here, but DealAid surveyed about 1,000 full-time US employees, and those are folks that are earning over $25,000, to find out what percentage were working remotely, as well as like what they saw as the best component and the worst component of working remotely. A couple of things that I wanted to touch on. The best was less commuting. I would imagine anybody working from home enjoys not having to drive to the office every day. I know Will has about a 35+ minute commute if it's good traffic, I would imagine. So not having to do that daily has got to be somewhat a bit of a relief. I know for my wife, she loves that. One of the worst is distractions at home. So kids, family, we've all seen that. I did test runs for the last couple of days, and I kept making this joke that my dogs haven't barked once. I heard them bark once during this. I don't know if anybody else heard it, but they barked today during the real thing, but they couldn't bark during the dry run, which was real great. Another study that will get into what the future of office looks like. Gensler reached out to a couple law firms, not a couple, several law firms, and Gensler is a national architecture firm, but they surveyed to find out who would prefer what type of future office setup. 46% of lawyers say they prefer to work in the office 5 days a week, while another 28% would like to have some sort of combination, a hybrid, and then only 10% said they wanted to work remotely full time. So really, it's coming down to what does the future of office look like, and how are we going to figure out the combination of in the office, some sort of hybrid or full-time remote. And I view that as coming down to, it depends on what industry you're in. Professional services are going to want their offices. They're going to want a place to go. I believe, you folks, I don't want to speak for you, but probably somewhere in between that 5 days a week to a little bit of a hybrid model, depending on what you're working on and who you're working with. The need for security is going to be important. But that brings me into, as a tenant rep, I have to figure out what kind of space is my client going to want in the future. So we're actually working on a new solution, which we call Culture. And it is spelled the way we intend it to here. That is not a misspelling of the word culture. But the CEOs that we've spoken to have really discussed the need to have some sort of flexibility. We don't want the financial obligation of a long-term lease 5 days a week. We don't want to spend the heavy money on traditional co-working, but we also want a place where we can have folks come and we can continue building on our culture as a business. We don't want to lose that by sending everybody out into the remote workforce and never having a in-person touch base. So what we're working on here is some sort of fractional time. It brings the remote staff together, but also allows companies to provide that perk of working remotely. And then it also works to sustain and improve that company culture, and focus on, we have a place, but we're not spending what I would dub as boku dollars on office space that we may not need. And that's the other thing. I think companies that are intending to be full-time office moving forward, they're going to look at what Will touched on earlier. How much square footage do we need for our employees now? Can we downsize that once we have this virus figured out and we're not concerned about the safety and health of our employees? Now let's figure out how much space we actually need. And we kind of think that that's going to look like 75%, 50% of what current office space requirements are now moving forward. So we see two different tracks, fractional, and that's something we're going to be working on personally, as well as downsizing. I'll pause one more time for any other questions, and then this is our contact information that I'll touch on real briefly.
Matt, that was great. Thank you for all of that information. Very helpful to us. And I know the Denver economy is unique in some ways, but it also mirrors what's happening on a national level, well, especially in some of our markets and Bailey. So thanks for touching on all of that.
Absolutely. Perfect. Well, looks like I have 1 minute, so I will wrap it up real quickly. This contact information, I think you guys have the slide set, maybe not, I can share this. At any rate, we have a team that focuses on what I talked about today, Office and Flex. That's Matt Brower, Erica, and then myself, Matt Weist. We also have an individual that focuses 100% on industrial, Thomas Bannigan, and then we have an investment sales professional, Kevin Andrews. So if you guys have clients, if you personally have questions about any of these different arenas, feel free to reach out to me, reach out to Will, and he can get you in touch with me, and we'll get you any questions you have. And then to wrap it up, I would like to thank Will for bringing me over to introduce myself and present these materials to you guys today. And I want to thank you guys for sitting through and learning a little bit about the Denver commercial real estate market and what's going on nationwide as well. Otherwise, if there are no questions, enjoy the rest of your day and week, and thank you again.